Good morning, ladies and gentlemen. Well, we finished the week at minus 25 on the score, so we worsened all week long. If we have a look at the daily scores here in the box, we started at minus 9 and then proceeded to worsen basically all week down to minus 25. As far as the weeklies go, still no buy signal. From minus 9 to minus 25, the moving averages are actually diverting slightly still. So we're still in 40% risk on in the daily and the monthly, while the all important weekly model is still invested in TLT. And with the situation as fluid as it is in the markets, this seems to be strangely appropriate. If we look at the databases, if we look at the deviations, we will see that the SPY is not very far away from the green zone. I still expect at some stage that we will touch the green zone and basically bounce from there. But as you can see, it's now narrowed substantially. So basically we are now in a trading range from somewhere around 27.75 to 29.40. That should be our trading range for the foreseeable future, and that is actually very appropriate for what the fundamentals are telling us. And here we are with the fundamentals. The time 16 Blue Angel comes in just below 2800, so that matches with that 27.75-80 area, which I think is going to be all important. And to the upside, I don't really see much upside, certainly not. We will see what the exact levels are later on, but I just don't see these tests of the higher levels, simply because the internals of the market are at the moment too weak, and we have no prospect whatsoever to an early resolution of the trade conflict. So I think the market is more likely to lose ground than to make ground. It will probably be one of those, up 3 days in a row, a few ticks, and then lose it all in a few hours. To my way of thinking, the 2-year note is at the moment the most important chart. Simply, I've taken it back a while to give you a bit of context to see where we came from. We came from roughly the 70 basis point mark. And if we now start closing below this 217, 218 line, which we are beginning to do, after a bit of time, I think the market is going to force the Fed's hand. And once the Fed starts cutting, we are going back to this 70 basis points level. So I just wanted to show you how big the optionality is in 2 years. Could we trade back at around 233, 235, even 240? Absolutely, without any problem. But I think that is as far as it goes. So we have 20, 25 basis points on the upside and a hell of a long way down to go on the downside. There is huge optionality in the 2 years. I love that area, and I'm going to stick with it long for until the market tells me that I'm completely wrong. If you put on some moving averages, you will see the 200 days somewhere around here, around the 250 area, and the 50 days somewhere around the 230 area. So both are pointing firmly down, and I think any move back up to these highs around 240 is going to be a gift to put on some really heavy option positions, looking for this 75 basis point area sometime towards the end of the year. I wanted to show you the Bund chart first, simply because we are at very, very important levels. Minus 16 basis points is where I get out of the Bunds, and I don't really want to know about them anymore, simply because I think uh, the risk reward at minus 16 is almost non-existent. Could we fall through it and go to minus 25 or whatever? Yes, anything is possible, but the risk reward is simply not there. To me, those are the most important levels. 8 basis points on the upside, after which we know that something very, very strange is going on and we don't want to fight it. And minus 16 is where we take our profits and again say we don't want to know about the Bund anymore. And if the Bund does go to minus 16 and it finds it very hard to break through that, then we know what happens next, and I will describe it now. And here we have what happens next. We break through these levels on the differential chart between the 10-year note and the Bund, and we start going up, 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 and everybody will start talking about this as a huge head and shoulders, and we're going back to where we came from. And we came from, you can see where we came from. We came from somewhere around here. This is the kind of equilibrium level that we had for years, and this is minus 200 basis points. So that's a move of over 40 basis points in the spread between the 10-year note and the Bund. And should that start happening, we will see very grave consequences for the value of the dollar. Here we have a chart of DXY, and you will know that I hedge my long dollar positions simply because what doesn't go up when it has every opportunity to go up eventually goes down. And so now I'm long calls and I'm hedged simply because I have fears that we will start falling through this 97.52 area and slowly go to the yearly pivot of 96.50. Should we, it will take some time, but at 96.50 we are going to have a very interesting technical situation. We will be on top of the 200-day moving average. We will be below the 50 and the 20-day moving average, which will be turning. We will be on this all-important trend line, which I can show you goes all the way back to early 2018. And if that happens and we start breaking through 96.50, all hell's gonna break loose. I think we will revisit the lows around the 90 level. That's a big move. That's a 7-8% move, which in for DXY is an enormous amount. And that is what I think could easily happen, because if we are right and the 2-year note starts going down towards 70 basis points and the differential in the 10 years between the Bund and the 10-year note starts going towards 200, the pressure on the dollar is going to be enormous. In a macro sense, that makes sense, because that is how the Americans can actually save their equity market by cheapening up the currency that you buy it in, and actually make people come in and buy their stock market. So that is why I say that the stock market is going to be a tertiary effect. The primary effect is going to be on the short end of the curve. The secondary effect is the dollar. The tertiary effect is the value of the stock market. So I think the stock market is going to be the one that's least affected, or in the long term could even be positively affected by a cheaper US dollar. What does all that mean for Euro USD? Well, Euro USD has been in such a tight range for such a long time. This is a weekly chart, by the way. So the first objectives, as you can see, it's trading very well along the bottom of the Bollinger Bands on the weeklies. The first objective really would be somewhere around this area, around 113.20, 113.30. the top of the Bollinger Band around 114.40, and then after a few weeks a breakout to this all-important line, which is 117.30. 117.30 was such a tough level to break for such a long time. I think that's the natural objective. That is as far out as I would like to go, trying to predict the movement in Euro USD. I think this would be a cinch around the 114.80, something like that. That should be our first objective, and then we probably try and do an inverse head and shoulders by trading sideways for just as long a time as we did over here. But that is about as far as I'm confident in looking ahead. As you know, I like to get confirmation from all kinds of markets for any view. So if we're going to have a weaker dollar, we should definitely have a stronger gold price. This is anything but obvious. This is a weekly chart. I think that when we get to 96.50, we'll be somewhere near this line. So we will be trading towards the upper end of the weekly Bollinger Bands, around 1335. I have bought some more gold and taken my allocation from a pathetic 2.5 to 3.5%. Not because I like gold, but simply because I'm running out of things to invest in. I think there is a decent likelihood that over the course of the next couple of months we trade up here towards the 113.40 level, but I really do not think that we bust this line for quite some time yet, and therefore that is all I'm prepared to risk and invest in gold. No real change in 5-year notes or 10-year notes. We're still in a very nice downtrend in both. At some stage, I think that stops, simply because the curve is now so flat, and I think the curve needs to steepen, and the way it steepens is by way of the 2-year collapsing as the Fed at some stage just throws in the towel and cuts rates. If the Fed doesn't do that, I find it very difficult to believe that people are going to be pressing a negative yield curve and negative carry. So I think that the trend in 5-year notes and 10-year notes is going to be much less pronounced than the trend in the 5 years. 5-year notes I really can't see below 197 to 193 for any length of time over the course of the next couple of months at least. This is a weekly chart of the 10-year note yield, and you can see how this 233 level is very, very important. We reached it last week. I think consolidation for the next foreseeable future, something like this, between 260 and 233, is what we are likely to get. I really can't see the 10-year note getting much weaker. Could we go to 203? Yes, but I really see no reason for it to happen now, unless the data starts becoming much, much worse than it is. If it is much worse than we've been forecasting, then I think we fall all the way down to 169 without any trouble, and that will be the trigger for the dollar to start basically collapsing through that 96.50 level that I was talking about. To me, it's too early. I would like to see several weeks of sideways trading before that happens, and that makes sense because the Fed has told us that they are basically on hold through the summer, sideways trading through the summer, and then in early autumn a very quick move down towards this 169 level. Well, what does all that presage for equities? Equity valuations are going to be supported by two things: the weaker dollar and weaker yields. So to me, the most important level for the year is still 28.64 if we're going to go and make new highs. But the most important level of support is 26.75. Why 26.75? Well, that is the pivot that was created by the Fed. It's not until we basically returned to 26.75 and then stopped, and only when the Fed told us that yes, they were absolutely on hold and absolutely they changed policy, we bust through it and we never looked back. I don't think we will break 26.75 unless we have a recession this year. To me, that is going to be the absolute bottom that the market can trade. What is this showing us at the moment? And these are the dailies, and we will look at the weeklies as well. Well, it's showing us that the market fails every time it gets to the red moving average, which at the moment is around the 28.50 area. And if it makes it slightly through there, it always fails at this kind of level, which is the 28.77 level, and it's coming down. That is why I think every time it gets to 28.64, you're supposed to short it, and basically you've got to buy it back against the 200-day moving average around 27.75, 27.80. To me, that is the natural range for the next several weeks, while the bond market meanders, while the dollar gets slightly weaker, and stays above that 96.50 level. Basically, all these levels are now coming into play in the next several months ahead. The dollar level, the yield level, especially in 2 years, and these very important levels in the stock market. This is a weekly chart of ES, and basically you can see how 28.64 is the level that it just cannot break through. As soon as it falls through it, it's amazingly strong resistance. What did it do last week? Well, basically it just went and got support of the red moving average. If we were to fall through there, then the next natural support is 27.75, which matches the 200-day moving average. I think it's going to take quite some bit of bad news to go through there, but if we go through there, we will probably fall straight down to that pivot that I showed you on the daily chart, which is 27.75. Sorry, 26.75. That is the pivot from the dailies, and that is the level that basically the Fed is going to try and defend at all costs. Even from an hourly perspective, we can see that the market is actually going to be relatively quiet. 27.93 here is the first support. Then it really targets all the way down to 27.36. I don't think that is likely to happen any time soon, and even the 26.75 level that I've put in is actually the 138% of an ABC, so I couldn't exclude it, but I think that the 27.75, 27.80 area is going to be very tough to break, and there is no reason for it at the moment unless some big news comes in. On the upside, it's very tough to see the market having any kind of strength to break 28.64, and even if it does, it needs to really take out the last of the moving averages, which at the moment is around 26.90. This actually matches up very well with the dailies, which basically say that the resistance is from 28.64 to 28.80, and only above there will the market have any strength to try and fill these gaps which it's left around the 2950 area. I really don't expect it for quite some time. I think the market is more likely to bleed than it is to surprise on the upside. Why do I not see a resumption of straight back up to new all-time highs, or even filling those gaps that the S&P left around the 2930 to 2950 area? Simply because the engine, which is tech, at the moment is very much broken. To me, that 73.19 is equivalent to the 28.65 level. And if we look at the weekly chart, we close right on top of it, and this just has the feel of a market which is going to do this for quite some time. And then that will correct all the overbought moving averages. I would have thought at least a week, at least a month of the market trading between 7,500 and down here somewhere around 6,900. That is the kind of range that I expect out of tech, out of XLK. And we all know that unless XLK leads strongly, the S&P just cannot get too much traction. On a monthly basis, NQ looks even worse. You can see how it never really goes and spikes the top of the Bollinger Bands without retracing it. And we have the top of the Bollinger Bands right where we opened this month, and therefore the likelihood is for more bleeding down towards this line just below 7,000 rather than for a straight back up. I would have thought at least a couple of months of sideways action here, and that is why I see it as so hard for the stock market in the States to go straight back up or even challenge those the previous highs. Much more likely to bleed, much more likely. We are playing the odds, so the odds say every time it rallies, sell it, because you should be able to buy it below 7,000. This is a chart of the cash DAX, a daily chart. What is likely to happen here? Well, probably an ABC. Targeting basically 11,740. That to me is a very reasonable level to aim for. So we have probably that's 250 points, that's 1.5%, which matches up more or less with what we are looking for in the S&Ps, that level 2775. Makes sense. The 200-day moving average is still pointing down. So some move down to 11,750, where you could probably set some long options, is what makes sense at the moment. Confirmation for these views also comes from the Russell. The Russell has been much weaker, and you can have a look at the transports, you can have a look at anything you like, and more or less it's the same picture. We will have very good support when we get to around this kind of area, 1,450. So what's that? Not even 2%. Yeah, just over 2% lower, 3%. So all more or less matches the S&P level around 2775. That is what I'm looking for, and that is a good area to have some long set. But you can see from these moving from the Bollinger Bands and the shape of the moving averages that we are likely to basically go sideways from that 1450 level. That is all one can say and forecast ahead at the moment, so more likely to bleed than not. And so we come to the biases for next week. I still think I've updated these levels. 213 to 235 is the range for the 5 years, and 233 to 250 for the 10 years. I still think this is not going to break those levels. 213, as I said, in 5 years is very significant. I think it's too early to break those levels. And 217 in the 2-year note, to me this is very important. If it starts repeatedly closing below 217, the pressure is building, weight of money is there, and you know something is about to happen. Minus 16 is still my target to exit all positions out of the Bund, and I don't want to know about them anymore. And I've updated these levels in SPX. I still think 2800, 2775 will trade at some point. And now I've updated this level. 2880 is my absolute top in the SPX. Closes above there and something completely different is going on. Always good to know where you are absolutely wrong. NQ, I just don't like it. I still think we will see levels below 7,000, and that will match just below 7,000, and that will match this level here, the 2775 in SPX. IUT still weak. I gave you the level in the video, and in the VIX really only closes above 1960 are worrying for me, and that will make me doubt that 2775 area will hold. Any close below there, and I think still 2775, 2780 is a great buy for the time being. In the DAX, I mentioned that this 11,750 level, to me that is an interesting level to go long of DAX. And in the one that is most important at the moment, I see 97.25 as a very good support for the DXY. If it starts going through there, 96.50 could come fairly quickly. I see no reason for it at the moment, but whatever happens, 96.50 is the level for the very big long straddle trade that I intend to put on, because from there something very interesting is going to happen one way or another. Thank you very much indeed. Have a wonderful Memorial Day, and I'll tweet to you on Tuesday.